Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monty, and this is a one-year daily candle chart of IWM, which is the iShares Russell 2000 ETF. As you can see, I've left my lines on the chart from last week's report, where I carried over the target line in this horizontal line right there, right around 199.79, and you can see obviously that on Wednesday we hit that target, but, and here's the big but, we formed a gap in the process. So now we have a gap above the market right there that does have a good chance of filling, and that might happen next week. So let me erase this line now that we've hit that target. I'm going to keep my channel lines in place. Those are the two parallel lines that we have running here on the top as resistance and down here as support. So I do believe that early in the week, I think we're going to see a rally in an attempt to fill that gap. And then I'm going out here and I'm putting a longer term target that might be out there about 2 weeks. Mainly because if you look to the left here, we have a gap to the downside. So right now, the Russell 2000 is caught between two gaps. So that's my forecast for that. Now, if we look at the diamonds, ticker symbol DIA, I am keeping that line in place. Again, that's that horizontal line at 337.65. Like the Russell, I think we could see a retest of this resistance and then ultimately we'll move lower. So again, nothing is changing on that target. I'm just leaving that in place as is. If I look at the Qs, this is interesting because the Qs also gapped down on Wednesday. This is another one where I think we can move up, fill that gap, and then ultimately come right back down to fill that target. The oscillators are still moving lower, but I do think we're going to see a break on Monday with that. I think the stochastics could start to move up. See this wide divergence right here between the K, which is the blue line, and the D, which is the red line. That wide divergence is something you have to keep an eye out for because that will most likely snap back to the percent D, and we could see a little bit of a rally there as well. So keep your stops in place. I have a alert going out over the weekend. It's an expiration week alert for all of our members. Every one of our positions are making money with the exception of Pfizer, which we have a long-term put on Pfizer. I think that's ultimately going to turn down next week. But we are in really good shape. If you're an option trader, we're collecting money from time decay. It's known as theta. So we can make money up, down, and sideways. And when you have the markets in a sideways channel like we see here, that's just, for us, that's just money in the bank. Month after month, we collect the premium and we keep rolling out to the following month. So it's a lot of fun. If you want to learn how to trade options, just go to marketrebellion.com, look them up. They'll answer any questions you have. There's no pressure there. If you want to look into some of the services and trade alerts that I put out through Market Rebellion, you can do that. But it's really a lot of fun, and we have a great culture of people in our membership. So that is marketrebellion.com. Now let's go on to the spiders, ticker symbol SPY. Same story with one slight exception. We filled this upside gap on Thursday right here. And then today, it's hard to see, I'll have to magnify that for you. Today, we close with a bearish Harami. And the oscillators are starting to hinge back down. So again, like the other ones, I have no intentions of changing that target. I still have a target down here of right around 430 exactly. Remember a couple of weeks ago I said that doesn't normally happen where I get right to the dollar, but that is 430. I'm keeping that in place, and then we'll have to see whether or not this support level way down here, 410, will hold. Now let's hop right to the VIX, because if you look at the VIX, I have some cycle lines here. You'll notice that the VIX is on a very tight cycle. It's very reliable. In other words, if you had bought the VIX on any one of these cycle lows, you would have made money after doing so. See, this is a very high probability chance right now that the VIX is going to rally up. Again, early because I think the markets could rally on Monday and Tuesday before the Fed news or Fed announcements. Maybe the VIX could drop a little bit, but I'm not changing these targets. These are staying right in place. Short-term target up there around 30, and I still have my longer-term target after that around 41.88. Not changing that one single bit. Now, again, for your option traders, when the VIX is trading below $22 here, this is a great time to be putting on diagonal calendar spreads. And again, you can follow along with my trade alerts if you're interested in learning how to leg into those and how to manage those and how to manage risk on those as well. So that is something I want to point out. Again, nothing is changing on these charts right here, and that is what we're doing as far as how we're approaching the markets. Now, finally, I want to bring your attention to this. I've been talking about this all week to our members. I'm going to show you this one more time. If you've seen it, great. Repetition is a great teacher. We're currently overlaying here this black line. It represents the current time frame for the S&P and how it compares to previous bear markets. Right? So this amber colored line is the bear market from 2000 to 2003. The blue line is the bear market from 2008 2009. This is one of the main reasons why I'm not changing my long-term bearish stance. We are in the early throes of phase one of the bear market, and you can see that it's almost an exact footprint of what we've seen before in the past. If you look at this amber colored line, let me just draw something for you here. We had a trend right up into 1999, 2000, and right here is when the trend line had broken, and then we continued on into phase one of that bear market cycle. And then what happened? Look right here. Look at the blue. It's hard to see it, but behind this black line there is another pivot point here. And what happened is the trend line was broken here. Again, very close to what we're seeing now in today's markets. And then the trend line became resistance as it reversed its role in what I call the kiss of death. We are at that same point in time. Why? Because we've already broken down below this low. The trend line is broken. If you remember, go back to January 28th and look at my weekly market report. That's when I officially called an end to the bull market. It wasn't because I just had this whim, I was going to just call it an end to it. No, it was because the trend lines were breaking, the moving averages were crossing, and now all indications are still pointing lower. Now, what does that mean for you if you're buy and hold? Well, it means that you need to shift that strategy from buy and hold to buy and protect. If you don't, then the market's going to slap you around, and then you're going to be stuck in this buy and hold until you break even 10 years down the road, perhaps, like what we saw in 2000 and 2008. Now, as we progress into phase one of this bear market, you have to understand that the acceleration of the selling pressure is going to increase quite dramatically. This low right here, as I magnify that right there, that low on the black line is where we are right here. Let me pull up my SPY chart again. That low that I just pointed out is right here, right around 410 or 4100 on SPX. This is a key support level, and I think as we come down to hit my targets, we'll probably bounce, we'll fail that, turn to resistance, and then we're going to be into the big test of whether or not that's going to hold as support. If you look at what's going on around the world, inflation is not slowing down. Gas prices are still going up. Food shortages and supply chain issues are persistent. People are becoming fearful. And with that, that's what usually drives us into a recession. A recession is when people get fearful, they hold back on spending their dollars. So they want to save their dollars. A difference between a recession and a depression is that where a recession, they're holding back on spending those dollars. A depression is, well, they don't have dollars to spend. We're not there. But ultimately, this market that we're looking at right here leads the economy, right? That's what Dow theory is all about. If I called an end to the bull market on January 28th, you have to understand that about 7 to 9 months from there is when the economy is going to start kicking into what I believe is going to be a great recession. So while that sounds negative, you have to understand we make money on the way down. Just learn how to do that. Learn how to trade puts. Learn what options are about. You don't have to just jump in with both feet, but take some classes, take some courses, and watch some videos, and then tiptoe into the market. You could start paper trading to build your confidence and not risk anything. And then when you feel confident enough, you could turn on the switch and make some money with us as well. So that's it for now. Have a great weekend. We'll talk to you soon. So long.